Life insurance is an important part of one's personal finance portfolio. But the real question is, which life insurance? In this video, we shall examine 5 different types of life insurance policies as we understand their construct, features, premiums, who should buy such a policy, what are the things that one should be careful of, and how one can make the most out of these policies. A term insurance policy is the simplest form of life insurance and are formally called protection plans. Simply put, a term insurance policy is one where a monetary compensation is paid to the nominee or beneficiary under the policy upon the death of the policyholder. There are a couple of important points to note here. First, the benefits under term insurance are payable only upon the death of the policyholder, which means if the policyholder survives, then no maturity or survival benefits are payable. And secondly, the death of the policyholder often covers most situations, including sickness and accidents. But like all insurance contracts, there are some minor exclusions like drunk driving, adventure sports, etc., that one must understand when buying a term plan. Now, over the years, the term insurance products have seen much evolution and now offer a range of options to consumers in terms of sum assured, age coverage, types of payouts, payment schedule, add-ons, etc. What adds to the popularity of term insurance is that these plans offer one of the lowest premiums and simultaneously offer the highest possible life coverage amongst all other insurance policies. For example, here's the monthly premium offered by some life insurance companies for a 35-year-old non-smoker male who's seeking a 1 crore term insurance plan. Notice here that the average monthly premium comes to about 1,700 rupees for a 1 crore cover, and had this instead been an endowment or money back plan, it's quite probable that the premium would have been much higher for the same level of coverage. We also see here that a number of different variables have been used, such as a cover of 1 crore, the age of 35 years, a policy duration of 40 years, male, non-smoker, lump sum payout, etc. And as a consumer, you can tweak almost every variable to ensure that you arrive at the premium that is most affordable to you. One of the reasons for highlighting this comes from the fact that the cost of term insurance policies, that is, the premium at which you start your term insurance policy, has been going up over the last 15 to 16 months. So if you haven't bought a term insurance plan, or if the life insurance coverage you have is less than 15 times of your annual income, then it's probably a good idea for you to not wait any further and opt for a good term insurance policy. If you need help with selecting the ideal term plan, do explore the many options we have on the ETMONEY app, and also watch these 2 excellent videos we have on our YouTube channel that cover how to calculate your term insurance cover. And then we have another video on the step-by-step process of selecting your ideal term insurance policy. So do watch these videos, and if you think a friend, colleague, or family member would find use of these, then do make them subscribe to the ETMONEY YouTube channel and share the videos with them over WhatsApp and Facebook. A whole life policy is for all practical purposes a permanent life insurance policy, which means this policy extends life insurance coverage until the demise of the policyholder, post which the nominee is paid the benefits that are listed under this policy. Now, the phrase whole life policy is not a standardized one, and we have seen different applications of that with different insurance companies. For example, some insurers use it as an extension of a term insurance plan that simply goes on till the age of 99 or 100 years, and nothing else is paid out other than the death benefit. But then there are some other insurers who define a whole life policy as one which not only has death benefits but also comes with maturity benefits, survival benefits, and even a bonus in some cases. The second structure might sound a bit confusing, so here's how a whole life policy is generally structured. Firstly, the policyholder pays premiums for a limited number of years, say 10, 15, or 20 years, but the life coverage continues until the policyholder reaches 100 years. Now, if the policyholder lives beyond 100 years, then he or she is paid the maturity benefits along with some bonus. But if the policyholder dies before the age of 100, the death benefit is paid to the nominee along with some bonus. Additionally, if the policyholder pays all the premiums, then a survival benefit is paid to him or her every year, which is generally a percentage of the sum assured. So there we go. There is a life coverage, a maturity benefit, yearly survival benefits, and in some cases, a bonus is also applied. Now, all these benefits differ from plan to plan, insurer to insurer, so it's important to read the policy wordings and other literature before taking any decision regarding any insurance policy. But do remember one rule, and it's something that we say quite often to everyone, irrespective of whether you're investing in mutual funds, stocks, or buying insurance, and that is, if ultimately you don't understand it, it's better for you not to buy it. An endowment policy is one which, apart from covering the life of the insured, also helps the policyholder save regularly over a period of time. This money that is saved is then given to the policyholder as a lump sum amount once the policy matures. This type of policy is pitched as a savings plan and is almost always linked to some future event which is a good 10 to 15 years away. For example, a popular pitch made by LIC agents to parents is to start contributing towards an endowment plan for their children's education or marriage. From a benefits perspective, an endowment policy comes with a life cover which is paid to the nominee upon the death of the policyholder. However, if the policyholder does not die and survives the policy term, then he or she is paid the guaranteed maturity proceeds with some bonus as the case may be. From a purpose point of view, the endowment plans are not a wealth creation or investing tool, and insurance companies never pitch it that way. These plans are quite clearly savings instruments which offer lower than average returns, but then they also offer guaranteed tax-friendly returns, which makes these endowment policies an instrument of choice for extremely risk-averse individuals. Money-back policies are another popular life insurance category. It's popular with the insurance agents as they make good commission of a money-back plan. But a second factor that lends to its popularity is the catchphrase money back, which at least makes people understand what this policy is all about. Let's understand how money back policies are constructed by examining the Life Insurance Corporation of India, or LIC's new money back plan. Now, LIC's new money back plan comes in two variants, a policy term of 20 years and another one that goes up to 25 years. For this illustration, let's stick to the one which has a policy term of 20 years. So as per the policy terms, a policyholder needs to pay premium for 15 years. So not 20 years, but 15 years. And there are potentially 4 benefits within the plan. First, there is a death benefit that goes up to 125% of the basic sum assured and is paid if the policyholder expires any time within the 20-year policy term. Second, there is a survival benefit which gets activated at the end of the 5th, 10th, and 15th policy year, and the policyholder is paid 20% of the basic sum assured in each of these 3 periods. The third benefit is the maturity benefit, which amounts to 40% of the basic sum assured and is paid out if the policyholder survives the entire 20-year policy term. And the fourth and final benefit are the bonuses, which is nothing but the policyholder receiving a share in the profits of the insurance company. This bonus part is entirely at the discretion of the insurance company and depends on the profitability of the insurance company. So money back policy offers these 4 benefits in addition to the tax benefits that accompany all life insurance policies. From a returns perspective, due to its guaranteed nature, one can expect the returns to be on the lower side. In fact, we tried out multiple combinations of premiums, sum assured, and age groups and figured that the IRR with respect to a money back policy often lies between 2 to 6% in terms of annualized returns. In terms of suitability, this product might work well for someone who is extremely risk averse, doesn't understand the basics of investing and is okay with a tax-free, low-risk, low-return investment product. Unit-linked insurance plans or ULIPs are a product of perspectives. Insurance companies and agents exhibit a ULIP's tax-saving and inbuilt insurance cover, often at the expense of playing down the impact of charges on the product's returns. On the other hand, financial planners and mutual fund distributors explain an outdated version of the chart structure which is almost non-existent in the modern day ULIP. So there is some propaganda here at play depending on who you are listening to. But quite simply, a ULIP or unit linked insurance policy is an investment product which has insurance built into it. In fact, ULIPs are pitched as a triple benefit product that offers investment, insurance, and tax saving benefits. One important thing to note here is that unlike an endowment or money back policy, ULIPs cannot guarantee returns. In fact, they cannot give you any indicative returns as well because the performance of the funds is linked to how the equity markets or the bond markets perform, which is why they carry the term market linked in their name. Now, the problem or the noise around ULIPs has always been around the charges that are payable by the policyholder. These charges come in many forms like a premium allocation charge, a policy administration charge, switching charges, and a few more expenses. These charges were quite blatant when these products were first introduced in India, but since 2011, the ULIP charges have been coming down and the modern day ULIP is very different from what it was a decade ago. If you're keen on knowing more about ULIPs, we have a detailed video on the ETMONEY YouTube channel, which is a must watch when it comes to the subject of ULIPs. A common trait across all 5 types of life insurance policies are the tax benefits that are provided under the Income Tax Act. Subject to some conditions, premiums paid towards life insurance carry Section 80C benefits, and a policy's maturity benefits are supported by Section 1010D, which makes them non-taxable. These tax incentives are a big part of the life insurance story. The other commonality you might have noticed is to do with the long-term nature of these products. Every life insurance policy has a term of at least 5 years going all the way to 100 years, as we saw in the case of whole life policies. In terms of differences between these 5 life insurance products, there are many variables to look at, but let's discuss a couple of these here. For one, all 5 policy types serve a different purpose for the policyholders. For instance, term insurance policies are for protection only. That is, if you die within the policy term, then your dependents will receive money which should provide some assistance towards their financial future. Similarly, a whole life policy is very clearly a way of leaving behind a legacy for your children. Endowment and money back policies are for savings, while ULIPs are designed as a wealth creation and investment plan. The other difference area we would want to highlight here is on competing products. So in the case of term insurance, there are no competing products, which means if you were to die today, there is no financial instrument that will pull out a crore of rupees and give it to your family. However, the other life insurance products have strong competitors, with the whole life policy competing with investment products and real estate, endowment and money back competing with fixed deposits, and ULIPs often drawing sword with mutual funds. From an ETMONEY perspective, we have been great supporters of life insurance and also hold the required IRDAI licenses, which helps us to collate and present the best insurance options to our users. In our opinion, having a term insurance policy is a no-brainer and one that every earning member should have in his or her own personal finance portfolio. With regards to the other policies, that is whole life, endowment, money back, and ULIPs, we really can't make any generalization here, and the need for such a policy will depend on a person's preference, and we hope the comparison table we have presented earlier might help you with that evaluation. And with this, we come to the end of this video. I sure hope this video has given you a better idea of how different life insurance policies work and how you can evaluate each of them per your requirements. If you like this presentation, then do help us spread the good word by sharing it over WhatsApp, Facebook, and Twitter with your friends and connections. Thank you for your time, and we look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.